editors are all here with their takes, so let me welcome all of them. Good morning to all of you. Lata, first to you, what are the big numbers to watch today?
Well, obviously the biggest number would be the GDP number. You look for nominal GDP, not real GDP. So real GDP, yesterday we got an idea it would be 8.1 to 8.5. You add to it an inflation number. The nominal GDP, if it is assumed at about 13%, the market will not be terribly disappointed. It looks too much for me, but the market is prepared for 13%. Finance Commission prepared us for that. Based on that will be the receipts number. You know, if you have a 13% GDP, your tax revenue receipts can be plugged at about 14% growth. So 14% growth will not be bad, but much before that, the market will look for the fiscal deficit number. Yes, that 3.6% would be very important, but the market is at the moment in the mood that it is able to forgive a few points. It will not forgive going up from 4.1 to 4.2. The direction should be lower, because last year's or current year's is 4.1, it has to be lower. But if it is not 3.6, I think the market is in a mood to take that in its stride. Then economists will also like the revenue deficit to be lower, and it's bound to be. From 3% it could fall 2.5%, people will be elated. Normally it doesn't fall so much. It falls like 2 or 3 basis points, 20, 30 basis points. Then of course the market borrowing, which is a number the market is prepared for. You know, the fiscal deficit is 3.6 to 4%, then the market borrowing will be about 6 lakh crore. That much the market is prepared for. I don't think the bond markets are going to swing very wildly. Then all the subsidy numbers, food subsidy not to worry much, because it's 1.2 lakh crore last year. It will be around the same number this year as well. Fertilizer subsidy will fall because the inputs into fertilizers have become cheaper. So 73,000 crores is expected to become about 55,000 crores. But the biggest number will be the fuel subsidy. It was about 63,000 crore last time, expected to come down to less than 25,000 crore. The big saving of about 50,000 crore comes over there. The total subsidy, therefore, should be 1.4% of the GDP. If that is achieved, the markets will be elated. Nobody will curse the government if it's 1.5 or 1.6. But the total tax revenues, like I told you, just to reiterate again, if you take a 13% nominal GDP growth, you must not go over a 14% revenue growth. Unless, of course, you've increased service tax, you've increased customs duty on crude, then maybe, you know, the markets will forgive 15, 16. But really, it would be better if they stuck to that 14, 15% number. And then finally, plan expenses, the biggest number the market is watching. It was about 5.75 lakh crore last time when it was budgeted. It's bound to have fallen because, you know, the government had to trim some expenses. This time, 6 lakh crore or 6.5 lakh crore will definitely elate the market. They will be a little worried about how the money is found, but, you know, some infra fund like Suresh Prabhu did, the market is willing to buy that. But that number will be very big. Okay, so that's it from me. Let me get to Menaka.
Good morning, Lata, and how exciting to be talking tax this early in the morning. Let me start first with the list of probable changes to tax policy. These are the changes that are most likely to happen, and I'm going to start with what the FM may do to increase spending power. Now, it would be great if he could eliminate the lowest tax paying slab, because 90% of Indians paying taxes on a taxable income of 5 lakh rupees and more, and from that, the tax collection is fairly minuscule. It's only towards the higher slabs that you in fact start collecting higher and higher tax revenue, as would be obvious. But I suspect that the FM will wait for the DTC to make any large-scale slab changes. So this year he might give that a miss. But he may increase exemption limits for categories such as conveyance, education, medical, because many of these amounts are very low, they're very dated, and they need to be contemporized or inflation indexed in your language. He may also increase the deduction limit. But I think he's going to do it in a targeted way, to target investments to a certain sector. For instance, the deduction on housing loans could be upped for the purchase of houses of a certain size and below in order to give affordable housing projects a boost. He may also adopt the same targeted strategy when it comes to boosting private investment. So you could expect tax-saving bonds to channel more money towards specific infrastructure projects. There is some buzz on whether he will rejig LTCG, that's long-term capital gains tax, from 1 year to 3 years. Again, I think that's just a rumor, and I think that any such big change he might leave for the DTC. Now, infrastructure has been a pet theme for this government, so I expect tax incentives for infrastructure projects as well as for infrastructure investors. There is also hope that he will extend the tax holiday for power projects to beyond 2017. That's the sunset time or sunset clause. But he does have some time to do that next year as well, so he may postpone that. Now let's get to the big list. What will he do to boost manufacturing? It's a long list, starting first with enhancing the investment allowance limit, as well as reducing the project size threshold so as to benefit small enterprises, and pushing out the sunset date as well on this one. One often repeated demand is to give industry the full benefit of earlier granted incentives. So for instance, if a company is availing an investment allowance, do not impose MAT or minimum alternate tax on that company. That is the request coming through. Speaking of MAT, there is hope that he will reduce the rate from the current 20%, especially for SMEs, SEZs and new manufacturing zones or projects. And speaking of SEZs and manufacturing zones, well, industry wants full tax holiday status restored to them. So that means not only no MAT, but no DDT as well. That's no dividend distribution tax. Skilling India, that's another Modi pet project, and there is expectation that training people could get a deduction. Just like R&D gets, training could also get a deduction, and that will be an interesting one. As for R&D deductions, the hope is that they might be extended beyond manufacturing. We also have the economic survey point to potential tax changes, especially to eliminate the negative protection facing manufacturing. So that could lead to a rectification in certain inverted duty structures. There are about 60 such instances, experts tell me, and it could also lead to an increase in duties on specific imports. And finally, in order to allow manufacturers to source foreign technology at competitive rates, there is hope that he will roll back the tax rate that applies on royalties and FTS to 10%. That was the earlier rate a few years ago. Now I'm going to get to GST, which is the biggest tax reform this country is awaiting. The service tax rate may increase to align with the final GST rate, and we do desperately need a progress update, especially whether the states are on board now that they have a bigger share of taxes. And last but not the least, this is also an important list, don't ignore it, a GAR deferral, that's going to be crucial. We also need some tax clarity on REITs and infrastructure trusts so that they can finally take off. A shift in the burden of DDT, that's dividend distribution tax, that one comes up every year, though, I don't think that one's going to happen, because to move the burden from companies to individuals makes the collection a little bit more complicated, so that's going to be a tough one. We also desperately need some clarity with regards to the indirect transfers tax law. This is the retroactive Vodafone amendment that took place a couple of years ago. There are some definitions there that desperately need clarification, and that's what industry is hoping for. And finally, we do need the FM to articulate on tax administration reform so that compliance improves, litigation reduces, tax collections improve, and essentially investing in India becomes an easier one. Now that's the list of probable tax changes. Let me get to the list of possible tax changes in case you haven't had enough tax so far. I'll start first with transfer pricing, and I think I've collected some 326 suggestions on transfer. Okay, I'm guessing you've run out of time, haven't you?
Well, Menaka, I hope the budget is as dramatic as that. I don't think it's going to be as dramatic as that. Well, we are calling it the Make in India budget with a reason, isn't it, Sonia, Anuj, Lata? So I'm not looking for directional signals, not looking to see which way the ball will swing. The direction is pretty clear. The market Anuj recognizes that, because that's why it's been going up so strongly. This is a government that understands that without growth, you will not get jobs. You will not get the money. You need to create a social security for those who need it. In the past, finance ministers like Chidambaram understood this pretty clearly, but it wasn't necessarily the party line, and this is important. So we would, on a morning like this, be less guessing on what direction the budget would take. That uncertainty is over. We would then be guessing, would the FM prevail, would the party prevail? Today, we know that the party line, the government's commitment to Make in India is clear from the various steps it's taken, whether in the form of ordinances or coal auctions. They know that to make in India, you need land, you need power, physical infrastructure that is, you need technology, you need capital. So all I'll be looking at then is the credibility of the numbers that Lata spoke about. Credibility of the ideas that we presented, what are the tax growth assumptions it makes, what's the oil price it will use in its calculation, how does it propose to fund infrastructure, the ideas to incentivize manufacturing, how credible are they? And yes, like you of course, I will be looking at the fiscal deficit very, very closely. There is consensus that public spending is needed to give the economy a booster shot, and all indications from the railway budget and the economic survey thankfully point in that direction. But we'll all be looking very closely at where this money is going to come from. Shireen, it's over to you. What are you picking up?
Well, it is the big day, and the buzz in North Block, as we've been reporting here on CNBC-TV18 over the last few days, is very clear. The 14th Finance Commission is going to be the big achievement that this government is going to hold up in the budget speech. The fact that the centre has decided to be so generous to state government is going to be something that the Finance Minister is going to focus on. But the question then is, what will that do to the fiscal space at the centre? The centre has acknowledged very carefully and very clearly that the recommendations of the 14th Finance Commission will reduce proportionately the centre's fiscal space. What then happens to the Chief Economic Advisor's vociferous pitch for greater public investment? What then happens to the fiscal deficit target of 3.6%? The buzz is that maybe we could see a slippage, but I know Lata will talk a little bit more about that in just a bit. But let me take you through all the other sort of speculative rumours that we've been picking up on. And I think one thing is certain, low-cost affordable housing is going to be a big-ticket area. Remember, the Cabinet had met. Our sources gave us to understand that the proposal was cleared by the Cabinet and they were waiting for the budget to make that big-ticket announcement, housing for all by 2022. So housing, low-cost affordable housing will be an area to watch out for. Manufacturing and Make in India, even though the Chief Economic Advisor has told us that exemption Raj must end, will they specifically give some relief as far as minimum alternate tax or MAT is concerned? That is a big buzz. Perhaps this is a time where a differential MAT rate specifically for certain manufacturing and infrastructure sectors is something that the government may consider. We've also got a lot of talk on an even more aggressive disinvestment target. Where is the money going to come from? That's the big question. And disinvestment is certainly going to be an even more aggressive target that the government is going to look at. There's also been a lot of talk in terms of whether this government is going to make the move towards aligning the indirect taxes to the GST. A service tax rate hike is being mulled, is what we were being told. Whether or not they will take that decision or not in the budget is, of course, the big question. So don't expect big bang reforms, as the Chief Economic Advisor then tried to temper expectations last evening. But this is going to be perhaps like the railway budget, a budget that will articulate what this government intends to do over the next couple of years. There may not be too many specifics in terms of the levers to pull just now, but perhaps they will lay out a roadmap for what we can expect in terms of the economic intent. But the market's not going to be happy with that. They will want to see that intent being translated into action, or at least some of the intent that the government has already spoken about translate into action. But that's the buzz here from North Block, and of course, in a short while from now, all else will be revealed.